Hello and welcome to the Rookies course on option trading. My name is Brian Overby. I am the Senior Options Analyst at Ally Invest and author of the Options Playbook. All right, so today's session is titled Options 301, the strategies. And Options 101 and 201 are in the books. We have developed a playlist that you can click on inside the chat box right now, and it will take you to all three of the sessions that you'll be able to watch on demand at any time on the Ally YouTube channel. So in Options 101 and 201, we laid the foundation to be able to talk about strategies today. So that's exactly what we're going to do. So let's get started. We're going to start right where we have started all three sessions, defining what an option contract is. So if this is your first session that you are attending, you need to know that options are contracts. They give the owner the right to buy or sell an underlying asset for a fixed price for a specific period of time, and it will obligate the seller to take the opposite side if and when the right embedded in the contract is exercised by the owner. Now, we've had two fictitious companies that we've been talking about the last 2 days, stock XYZ and stock ABC. Now, we see these two option quotes, and we know that in the body of the contract, all those words are there, talking about the buyers getting rights, the sellers taking on obligation. But the stuff that we really need to know is basically in the quote. We need to know the expiration date. We need to know the strike price of the option contract. We need to know what the underlying is, what that symbol is. In this instance, XYZ and ABC is our put option, the two flavors of options, the call and the put. And then obviously the price of the option contract. So we laid that foundation. Today we're going to talk about the four basic things that you can do with an option contract. And we're going to focus on the buy side of things. So we're going to talk a lot about buying a call and being long that call option. That's going to give you a right to buy 100 shares of the underlying stock at that strike price. And then we're going to also talk about buying a put. And buying a put means that we're bearish on the marketplace. We're going to have a right to sell 100 shares of the other underlying. We are then going to take a step back and we're going to look at selling a call option. Now, this is going to be the strategy that we're going to emphasize as a get your feet wet strategy for the beginning option trader. We're going to talk about a covered call strategy. Now, if I sell that call, I'm going to take on an obligation to sell stock. And if my strike price is higher than where it's currently trading, basically I'm saying that if the stock goes up, go ahead and call the stock away from me. Now, I am going to spend more time on the first two that we mentioned, buying a call and buying a put. And the main reason why is that a lot of beginning option traders gravitate towards those strategies. I've mentioned it a few times over the last 2 days about the 5 mistakes that rookie option traders make. And a lot of times when I talk about that, I talk about just always buying out of the money calls, always buying the cheaper call option. And so today we're going to kind of focus on that. Then we're going to touch on puts, and then we're going to give you the strategy that if you do own some stocks, this is a great place to start. So I am actually going to run to the playbook, and I'm going to highlight a section here called the Rookies Corner. And inside that section, you will see that we are getting our feet wet, right? We talk a lot about the things that I mentioned. Here's XYZ stock, about buying out of the money, buying cheap options, talking about the concerns with it overall. And then the strategy that we highlight, that's the second one on the list, is writing covered calls. We'll talk about buying in the money calls as a substitute for the stock. And then if you'd like to read the 5 mistakes article that I've talked about more than once, I've actually have 2 different articles. I have one that's called the top 5 mistakes, and then I actually expanded it and talked about the top 10 mistakes overall. But inside the playbook, we highlight the 5 mistakes. So this is your homework. If you would like to review everything that we're talking about today, this is a great little section to start if you're going to start trading options and looking at strategies. Okay, so let's go back to the presentation. And let's get into the strategies. All right, so we're going to focus, we saw this slide on the 101 course, Options 101, and this is what we're going to focus on. If we are buying option contracts, which option contract would you like to buy? If the stock is at 70, this axis is the stock price, and the strike that we are trading is 70, that would be an at-the-money option contract. And that's the first strategy that we're going to talk about. We're going to highlight what is an at-the-money option contract and what is the break-even and everything that's involved with buying at-the-money options. We'll then talk about an in-the-money option contract. So if the stock went up at this point in time, say we started by buying the 70 strike call, that call would then eventually become in the money. That means we can exercise our right, buy the stock via the option at 70, and sell it up here at 80. So it's got real value, intrinsic value is what we defined yesterday. And then we'd say, well, let's talk about out-of-the-money options. Let's say the stock went down from this point in time. That would be considered an out-of-the-money option. Might we want to buy an out-of-the-money option to start with and not buy the at-the-money option contract? Now, there is no golden book of answers. There's just trade-offs. And with options, they're rightly named. There are a lot of options overall as to what strategies you can do, how you can create a option strategy to match your forecast that will be profitable if your forecast is correct. So we're going to start with an at-the-money option contract. And here's our situation. Fictitious stock XYZ, it's trading at 60. We're bullish on the market, but we want limited risk if the stock decreases in price. And I'm going to talk a little bit about the leverage factor. So what I'm highlighting by saying I want limited risk, I'm saying that I was thinking about buying 100 shares of stock, and if I bought 100 shares of XYZ at 60, that would be $6,000 plus any fees that might be involved in actually purchasing that stock. Obviously, commissions have kind of gone away in the brokerage industry overall, but in general, there could be some other fees. If I am bullish on the forecast, but I want limited risk, so I'm going to buy one call option as opposed to buying that 100 shares of stock. So I just want to set your mindset there. So our strategy is to buy a 90-day, 60 strike call option, and that's trading for $3. That means our overall cost of this trade is going to be $3 times the number of shares that the contract represents, which is 100, or $300 plus any commission or fees that there might be. At Ally Invest, we do not charge a commission for buying 100 shares of stock. Max risk would be $3 or $300, what you paid for it. The max profit is unlimited here. So now unlimited is a big word, right? But ideally the stock could go up to infinity, and if it went to infinity, you would make unlimited. But just like owning stock, you have great upside potential if the stock just keeps going. We got a few stocks out there that have tried to go to the unlimited range, but especially recently with a lot of the technology stocks. But if that is the case, we have the same type of upside from buying the call option as we do from buying the stock. Now, we don't have the same break even. Options have time premium in it. We've talked a lot about time premium. In this instance, this is an at-the-money option contract. It's all time premium. So our break even in this scenario would be the strike price plus the premium, which is $63. So if I'm going to buy this and I'm going to hold it for the entire 90 days to that expiration date, I need the stock to at least get to 63 before I would break even on this position. Now that's at expiration, okay? We talked a little bit about time premium yesterday. We went through a little quiz on buying out of the money option contracts. And when we get to the end of the show, we'll talk a little bit about how much different the price of an option contract might be on day 1 as opposed to on day 90, okay? So keep that in mind. Right now, we're going to talk about these strategies at expiration and do a little bit of analysis just overall, okay? So here's our profit and loss graph. They're very important in the option trading world. We have a live, with real-time quotes, profit and loss graph inside the Ally Invest trading platform. And I'm going to go to that profit and loss graph at the very end. But let's start with a very basic one. Okay, so we have the profit and loss here on this axis, and then we have the actual stock price on this axis. If we were to buy stock outright, that's going to be the blue line right here. If we went out and bought that 100 shares that I was talking about, your break even would be 60, right where we cross this axis. You would have unlimited upside potential. This goes on to infinity as the stock goes up. But you would have substantial downside potential. And we use the word substantial in the industry mainly because it can't go below zero, right? Some companies like Enron tried to go below zero, but most companies can't go below zero overall. So your long stock at 60, unlimited upside, substantial downside, if we buy the call as an alternative. We buy one call option as opposed to buying 100 shares of stock. That's trading for $3. We have the little hockey stick figure. From 60 on down at the expiration, and I should probably emphasize that, we're at expiration, 90 days has passed. The maximum we can lose is at $3 overall, and any fees that we might have paid. Then we have the same type of upside, unlimited upside on the option contract, only for 90 days though. At 90 days after that expiration, that option ceases to exist. And this is the difference. Here's the trade-off. I don't have to put all the capital up to buy the stock, to buy 100 shares overall. I buy that option contract. I have the right to buy the stock at 60, but I don't have the obligation to buy it at 60, which means that if the underlying stock goes below 60, I only lose what I paid for the option contract. I don't have to exercise my right and buy the stock at 60 overall. If I hold this all the way to the expiration date, that option contract to rent the stock per se, or rent the right to buy the stock, had some time value in it. So I really needed to get to 63 over that 90-day period in order to break even on this trade. Okay. So with all that said, I want to address the fact that I've been talking about buying 100 shares of stock versus buying one option contract. So I'm going to start with a question, okay? And open up your chat box. You can put your questions in. I'm going to try to answer them as we go along here. But I have my chat box open up today, and I would like to see some of your answers here. The question right on the top of the screen, right on the top of the slide right now is the outright buying of call options. Is that considered to be a speculative or a conservative strategy? You can just put an S or a C in the chat box right now. I'd like to see some of the answers. This is interactive. This is one of the beautiful things about the Ally YouTube channel is we always try to make these as interactive as possible. What do you think? Is it a speculative or is it a conservative strategy? And if you put that answer in the chat box right now, I will be able to see it. So if I do that, put either an S or a C. And as you're answering this, I want everybody to play in my reindeer games. That's kind of a rule of the Rookies Course on Option. You have to play. You don't have a choice. I'll just stop. I won't keep doing the presentation. All right. So mixed bag. So far, the S's have it, as you can see, and I'm going to say it's getting pretty close to 50-50, and that is actually the correct answer. As far as option trading is concerned and the leverage factor that's in the option contract, it depends. It depends how you use that option contract overall. So let's talk about Peter and Linda. Let's say you have $6,000 in an account, and we'll focus on Peter's side. Peter normally buys 100 shares of stock. Stock was trading at 60. Good for Peter because he has $6,000 in the account. He could buy 100 shares and use all that money. 100 times 60 equals 6K. Peter finds out about options. Doesn't go to the Rookies Course on Option Trading, so just decides to go to the Wild Wild West and says, why would I go out and only buy 100 shares of stock when I can buy 20 call options? They're trading for $3. I can't believe how inexpensive they are. So if I buy 20 call options, I would also spend that 6K. 20 times 100 times 3 would be 6,000. Now in the options trading world, you got to add in commissions. That is a real world cost. So ideally we would need a little bit more than 6K, but I'm going to be spending basically the same amount of money that I would on buying my 100 shares. Now, Linda, on the other hand, goes to the Rookies course on options, and Linda has the same concept. She likes stock XYZ, and she has $6,000 in her account also, and she decides that she's going to buy one call option because over the short term she's a little bit nervous about what might happen to XYZ. So you can look at it as Linda approaching this as a fear of missing out. I'm a little nervous about the downside on XYZ, but I do think that it could go up over time. So I am going to buy one call option, which allows me to buy that 100 shares, and I'm going to pay $3 for it. Just in case that underlying stock ran up, let's say 5 or 6 points over the next 90 days, at least I'm participating in that movement. So after that time, maybe I might want to exercise and buy that stock and own that stock overall. She then deposits the remaining amount into a money market fund and earns interest on those monies, obviously in that money market account. So, two completely different scenarios. With Peter, if he bought the stock outright, Peter basically, if he bought the stock outright and the stock didn't move at all over those 90 days, Peter would be at break even, right? If Peter buys the 20 calls and the stock doesn't move at all or even ticks down a little bit, well, Peter's going to be out that entire 6K. So there's the trade-off. There's the leverage factor. How many should I buy? Where do I feel comfortable doing? Linda, in this instance, might have bought this, and could that stock go down more than $3 in the next 90 days? Yeah. So Linda has actually limited her risk. If it went down $5 or $6, she looks like a genius as opposed to buying the stock outright. On the upside, if it went up at least $3, and that's one thing that I would need if I held it all the way to expiration, because that's where our break even is at, or it ran to $5 or $6, well, then I've done better. Overall, at least I had a position in XYZ, and I was able to profit overall on that trade. Obviously, Peter is much more speculative. Linda is much more conservative. Where do I want you to start if you're a beginning option trader thinking about buying 100 shares of stock? Go to the Linda side of things, right? If you're going to get your toe, if you're going to stick your toe in the water, we want to be a much more conservative option trader than we want to be a speculative option trader overall. All right, so I did have a few questions that came up, and I figured this might create some questions to start with. So before I get too far along, let's see here. Roger asked a question. Can you lose money if the premium was more than the in-the-money profit? In this case, in your first example, company XYZ, on the intrinsic and time value from session 1. Right, okay. So you're foreshadowing again, Roger. The next scenario is going to be an in-the-money option contract, and we're going to talk a little bit about the differences between the at-the-money and the in-the-money and what exactly will happen there. And then William then comes in and has a question about options. So I'm going to answer. So Roger, I'm going to answer your question in the next two or three slides. Okay, William, on your example, how do I exercise my right to buy the stock at 60 before the expiration? That is a great question. How would I exercise my right? We did talk about this in session 1 in detail, but all I have to do is call my broker. The brokerage firm has to be open, and at any point up, and we are just talking about stock options here, so I want to emphasize that. We're still in the stock option world. We're not in index options. It's a little bit more advanced trading. But all stock options, you can exercise your right early. That means that you just call up your broker and you say, I would like to exercise my, in this instance, we were talking about a 60 strike call option. I'm going to exercise my 60 strike call, and I'm going to buy in Linda's account 100 shares at 60. You just let them know that you do that. Now, the bigger question is, if I exercise it, how long do I have to wait to sell it? Can I sell it right away? The answer is yeah. If the market is open, let's say I call the brokerage firm Ally Invest. You call Ally Invest at noon Eastern time, and I say I want to exercise my right. At that moment, on that same call, I can sell that stock because as soon as I tell my broker to exercise, we know the buy price. The buy price is going to be 60. The broker knows the buy price. As long as you have the capital to buy the stock, they're going to buy it for you overall. And then you can go out and sell it instantly on the marketplace. Now, William, that question, if you talked about that, you're going to want to go to session 201 and talk about the most common thing that is done in the options trading world. As opposed to exercising it early, which you can, it just doesn't happen that often. Why? Well, there's time premium in the option contract. And if I exercise it, I lose that time premium. So let's say this is a 90-day option contract and we get to day 45 and I decide, you know what, I just want the underlying stock. What I would do is I would sell the option, get the intrinsic value if I'm right on my forecast, and get the time premium, take the monies, and then go buy the stock on the marketplace. And so that's the most common thing that you will see. There is a section inside the options playbook that highlights this, and you can see that section we highlight. I'm not going to go there right now, but we highlighted that in session 201. But most of the time, over the years, only about 10% of option contracts actually get exercised. Very rarely does that happen overall, but it actually happens more often on the put side of things. Why? Well, we went through a scenario where we bought a put on a stock that we own. Stock went down, said, heck, I just want to sell my stock at the higher price, at the strike price. So that's one area where you see more people exercise put options to sell their strike because they bought them as a protection method overall. All right, got a little long-winded and I got a lot to cover today. Okay, last question here. VJ, well, in the money, can you sell your option contract and earn some profit without buying the stock? I think we just covered that. There you go. All right, back to the presentation. Okay, so now we talked about this time component quite a bit. I have not addressed the time component yet in options 101 or 201. But you need to know that that time components do decay. And in the options trading world, they decay at an accelerating rate. So we've been talking about 90-day option contracts. If we bought an at-the-money option contract that had 90 days remaining to expiration, and that option was trading for $1.73, okay, one 90-day option trading for $1.73, you would see that for basically the first 45 days or so, it's a pretty linear decay over time. If the stock didn't move at all, one second. If the stock didn't move at all, basically from 90 days down to 45 days, we would be down on that option contract because time value will erode. It's the same type of thing as buying insurance on your car. If all of a sudden I decide that I'm going to change insurance companies, you do get some money back, but you don't get the whole premium back because I bought a 6-month policy and I'm 3 months into it. And now I'm going to switch to a new insurance company. They will give you money back, but they're not going to give you all of the premium back. Same thing in the options world. Now, in the last 2 weeks to expiration, which I'm highlighting here on the chart, it's like, wham, my sled hit the tree, right? Time decay is extremely high in the last 2 weeks to expiration. And we'll talk a little bit about that and the trade-offs in it. But right now we're going to focus on the 90-day option contract. When we get to the real option chain, I will talk a little bit more, the option chain within the Ally Invest trading platform, about buying near-term versus long-term options overall. All right. Now this is an at-the-money option contract, right? I want to emphasize that. So the stock and the strike were right where they were at. That's where you see the most time premium, and that's where you get the biggest drop-off. If the stock goes nowhere, that's where you get the biggest drop-off as far as time value is concerned. Okay, so now to answer someone's question that was out there, if we look at buying an in-the-money call option, let's look at that scenario. Stock XYZ is trading at 60. We're bullish on the stock, but want to limit the risk if the stock decreases in price. Same type of scenario. So we buy the 90-day 55 strike call option. We see it trading for $6.30. So now this is a little bit more expensive. So 630 times 100 is $630 plus commission. Guess what? That's still our max risk. but we have some real value here. So if the stock even goes down a little bit, this is going to be worth something by that expiration date. Still have the unlimited profit. Our break even is now 61.30. Our other break even was 63 overall. So right now you can see the benefit as far as break even is concerned on buying deeper in the money option contracts. What it really comes down to is that they act a little bit more like the stock. You are going to get rewarded quicker by buying an in-the-money option contract. It doesn't have to move quite as much before that expiration date before you actually become profitable on it. So let's look at the profit and loss graph and let's talk a little bit about it. You see our risk has been changed, right? The last graph, we were right around here with where that little hockey stick figure came in. So from 60 on down, we had limited and known risk of that $3. Now we're talking about the same stock, but we bought the 55. So if we come down a little bit and we go to 52, 53, well, we didn't lose our entire investment. We still have intrinsic value. We could exercise, buy the stock via the call at 55, sell it at 57. So the max risk doesn't kick in until we get down to the strike at 65, and then we have limited and known downside from there on down. Still substantial upside, just like owning the stock. We didn't pay as much time premium. Most of the price was intrinsic value. It did cost more, but the time value went down. It was only $1.30. So our break-even point now is 61.30. And this inside the rookie's playbook about getting your feet wet is one thing that we highlight. Buying in the money option contract as an alternative to buying stock. So in this scenario, to go back to the Linda and Peter situation, Linda would probably be more apt to buy this option contract than the at-the-money one. Why? Because she's buying it as a stock substitute. She's trying to buy something that will act a little bit more like the stock. Now, it's a derivative of the stock. It's never going to act exactly. Well, I guess if we get way deep in the money, you might have something that acts a lot like the stock, moves exactly like the stock. But overall, she's buying it as a surrogate for the underlying stock. Instead of paying $6,000, maybe I just pay $6.30. And it's very similar to the stock price movement then. Whereas Peter wants to buy as many as he can. So he ended up buying 20 at the money option contracts. And that would be a more speculative thing because you want that leverage factor. Now, obviously, if the stock went up 10 points, Peter looks like a genius overall at that moment because Peter's going to be rewarded more than Linda would have in that scenario. But this would be more of an investment type strategy by going a little bit deeper in the money. All right, now we have the third situation. XYZ stock is trading at 60. We're speculating on a bullish move. Now, I even used the term speculating in the market forecast. But we wanted limited risk, so we're going to stay with just buying one option contract, right? So I'm buying one XYZ 90-day 65 strike call. It's trading for $1. Our total risk here is $1 overall, or $100 plus any commissions that we pay. Our max profit is still unlimited, but our break even is now 66. That means that we need this underlying stock over the next 90 days. To get to that break even, it has to go up 10% on the stock price. A lot of people that are buying these option contracts don't think of it that way. And if you look at the profit and loss graph on this scenario, buy the stock outright at 60, unlimited upside, substantial downside. We buy the call. We have very limited downside on this as long as we don't use the leverage factor and buy as many as we possibly can. Use our entire $6,000 that was in our account. But we do have unlimited upside once we get to the 66. Now, highlighting once again, we are at expiration on this. Okay. So those are the three different scenarios if you are looking at buying options. Now, out of these three scenarios, I've highlighted all these profit and loss graphs on one slide. Let's have another little quiz here. Which one do you think beginning option traders like to do? Buy in the money, buy at the money, or buy out of the money? So we can just answer this question by putting in an A, an I, or an O. Which do you think is most common? I know I've been teaching options for over 30 years. What do you think I see more often on beginning option traders? What is the most interesting one to them overall? Okay, so you have to put the answers in the chat box. Once again, I just don't go on unless you play in my reindeer games overall. All right, well, the first three answers, one was at, one was out, one was at, one was out. Okay, so the ats and the outs have it. I do not see anybody. Oh, Elizabeth finally came up with an in. So that's the first in. Cybertruck has got an in. All right. The people that just jump in full-heartedly into option trading, beginning option traders, they have a tendency to buy the out of the money one. Why is that? Well, it's a lot to do with people that buy stock overall. A lot of people don't want to buy a stock like Amazon because they can't buy 100 shares. They want to be able to buy a lot of it, right? So rightly or wrongly, they decide to buy a cheaper value stock only because they can buy 100 shares of it. So when they go to the options marketplace, they have a tendency to buy the cheaper option. Why would I go out and buy one in the money option contract and spend $6.30 on that, or $630, when I can buy 6 out of the money option contracts? I sound better at the cocktail party. Yeah, I own 6 of those option contracts on XYZ. Without understanding that, you can be correct on your forecast on an out of the money option contract and still lose money on that trade. And we went through that scenario in options in 201. That's where we spent the bulk of our time at the end of the 1-hour session yesterday. So if you want to learn more, go in and look at that option pricing. So yeah, this is the most common thing that I see. I see people use too much leverage and they buy the out of the money option contracts. And overall, my attitude on out of the money option contracts, I'm not saying that you should never buy them. I don't think it should be the first option that you buy. If you are buying an out of the money option contract, and in our example, we have a 90-day example. If you do not think that that stock is going to go up 10% to 66 at least by that expiration date, I would not do the trade. And if I were to buy, if that was my forecast, if I saw something on the chart, the Fibonacci ran into the Bollinger Band and it hit the moving average, and wow, I really think the stock can go up $10. If I was that bullish on it, I would buy the 62.50. I would buy the strike right in the middle. Because if I do think it's going to go to 66, I want my option contract to at least get in the money and get some intrinsic value overall. So if my target's 66 over 90 days, I'm going to buy the 62.5. And that's because, and that's still a very speculative trade overall, but options really start rewarding you when they get in the money. And that concept overall is because of delta. So let's go in and let's look at some deltas. How about that? Let's go to the option chain here for a second. And I'm going to just take a little sip of water. And now we see the option chain on Apple. We talked about a lot of the different expirations overall. The December 17th has 15 days remaining. We're going to stay in that, but I'm going to check a couple other option contracts. So this is a 15-day option contract, and that's right in the heavy weight of decay on your option contract. And then let's go out and look at a 36-day option contract. And we'll go a little bit further and we'll look at, well, we don't have a 90-day. I guess we'll do 106, okay? And we're just going to talk about in the money and out of the money options. And I'm going to stay on the call side. I'm going to look at a put trade, and I'm going to also look at the trade that I would prefer that you use for beginning option traders, selling a covered call overall. We're going to talk about those two things in the next 15 minutes. All right, so I highlighted delta yesterday. Remember, delta is how much your option should move for a 1-point move in the underlying stock. That's what we said yesterday. So if I buy this out of the money option contract, Apple is at 165. Now, I also have to emphasize, not meant to be a recommendation. I have to say that because we are a brokerage firm where we're just trying to learn here overall. So we're using Apple because it's a well-known underlying stock, not because we think you should buy it. All right. So Underlying stock is trading at 163.53 on the live quotes here. We have the calls on this side. We have the puts on that side. We have a bid and an ask. That's the price to buy the option contract. Here's the last trade. We have volume and open interest, which we went into great detail yesterday. Now we're going to talk about the delta. So if I buy this out of the money option contract to 162.50, the asking price is 237. Very good market in that the bid price is 235. So we're only 2 cents wide on the option contract. We have a lot of volume, a lot of open interest, and that's part of the reason why we have a liquid option marketplace. But the delta is 35 and it's 0.35. Delta represents the potential movement in the option contract. It's a theoretical number based off of the per share basis. So if you bought one option contract and the delta was 0.35, you would take that and multiply that by the number of shares, 100. So this means that if the underlying stock went up $1, you would expect to make $35 on this one option contract overall. That's the way that I would approach it. So delta gives you a realistic expectation. It's a little bit advanced for a basic course, but we laid a really solid foundation. So I don't mind talking about delta. We highlighted on our option chains for a reason. And now what I want to talk about, though, is that what happens if we get in and out of the money? If we are at the money, in this instance, the most at the money contract right now is the 162.50. And a lot of times when in the real world, when you say at the money, you're just talking about the one that's closest. It doesn't have to exactly be there. But the 162.50, we mentioned yesterday that if you're at the money, the delta is going to be around 50. And in this instance, we're at about 56. It's a little bit bigger than 50 in the real world. But I do also want to highlight that if I look at the put side and I look at that same strike line, the delta over here is 44, but it's negative. That means that if the underlying stock goes down 1, our put goes up by 44. But notice that if you add 56 plus 44, that adds up to 100. Now, it's not always that accurate overall in the real world. You get some weird things that can happen. But in theory, they should always add up to 100 because we talked about delta being based off of probability. And if it's an at-the-money option contract, delta is kind of figured by looking at what's the probability of that at-the-money option contract being at least 1 cent in the money at expiration. And if it's at the money, it's about 50-50. It goes up, it's in. It goes down, it's out, right? So the delta is fairly close to 50. Now, there's some other time components. Reason why the call is 56 is we're a little bit in the money. The put, we're a little bit out of the money. And notice that our chains highlight that. If on the put side, if we're out of the money, we got a little bit lighter gray. And on the call side, we would be in the money, so we have a little bit darker. So we do highlight that inside our option chains. But they do add up to 1 because if you think about delta, they have to, right? So if I go and I look at the 167.50 strike call, that is 37. Well, add that to 63. That's 1 on the put side too. So these are lining up they're pretty straightforward. And I would expect that in a stock like Apple. And it has a lot to do with liquidity. One of the more liquid underlyings just overall. Okay, now I'm going to blow your mind. I'm not going to scroll down yet, okay? I just moved it up on purpose because I don't want you to see the answer. If I go out to the 36-day call option, and I look at the 167.50 strike, we see the delta at 0.37 right now. Do you think that the delta will increase or decrease or stay the same? And I'm not going to spend too much time on it. So I want you to think about it. Get the thought in your head, answer it. You don't have to throw it in the chat box. Do you think the delta will increase, decrease, stay the same? It's the equidistant out of the money option contract on the call side, but we're going out further in time. The answer is that it will increase. The delta is now 41. Why is that? If you think of delta as the non-textbook definition, it's not 100% this definition, but on the trading floor when I worked at the Chicago Board Option Exchange, everybody thought of delta not as a COVID variant. They thought of it as probability. And if I have more time and I'm out of the money, I have a higher probability of it reaching that strike. So my option reacts accordingly. Now I have to pay more for it, $4.40 here, as opposed to over here, $2.50. But I get rewarded more via the delta, or in theory, than I do if I buy the out of the money nearer term option contract. Okay. And so I'd be down on the trading floor all the time. And if you think of delta as probability, I would say, hey, George, you want to go to lunch at noon today? And George would be, oh, 20 delta. Markets are really busy. I don't know if I'll have the time. Overall, the day closes, and there used to be a place right across the street from the Chicago Board Option Exchange that said, that was called the Cactus. And the servers at the Cactus always wore t-shirts that said, don't drink and trade overall, as opposed to don't drink and drive. Haha, funny. But yeah, they did have those shirts. But if I would have said, hey, George, let's go after the market closes and hit happy hour over at the Cactus. Oh, 100 delta on that one, right? There's a very high probability overall. So market makers always talked of delta as probability as opposed to the textbook definition, which is the more accurate definition overall, that it is how much your option will move relative to the stock price movement. Okay, let's move back down now. We focused on out of the money option contracts. So what is my theme here? We talked about time decay and we talked about delta. I have to pay more for that option contract, but if I go out further in time and I buy a just out of the money option contract, I get more delta and I get a slower rate of decay overall. So if I'm buying out of the money option contracts, I would rather err on the side of going too far out in time. I could just come to myself and say, all right, well, I wanted to limit my risk to $2.35. Well, I buy this call option, this 167, I pay $4.25. How about if it gets down to $2.35, I just say I'm going to sell it. Now, obviously you can't deal with gap openings and it's possible you might miss that, but that would be my concept. I would rather buy a longer term option contract and say I'm going to sell and close that position if it gets down to where my risk tolerance is at, right? As opposed to buying the shorter term option and hope that I get the timing right and I get this huge rate of time decay as expiration approaches, and I don't get quite as much delta. And the marketplace doesn't think that it can get there as fast, or the probability of it getting there is lower because the delta is lower than it is on this option contract. Okay, so now let's flip the coin. Let's say we're going to buy an in-the-money option contract. Let's look at, and I'll scroll this way so you can't see it overall. Let's look at the 160 strike call. The stock's at 163, 160. So we're $3.42 in the money, right? Because I can exercise buy my call at 160, sell it on the marketplace at 163.45, right? That's how far we're in the money. This delta is 61. If I go to the shorter term option contract, if I scroll up in the chains, will the delta be bigger or will it be smaller than 61? Will it be a larger number or a smaller number? And the answer is it will be larger. All right, so the 160 is now 64 as opposed to 61. Why is that? Well, if you think of a probability, this option's already in the money. And it's the probability, now, and I want to emphasize this, it's not the probability that you're going to make money on the trade, it's the probability of it finishing at least 1 cent in the money. That's the way we're approaching the delta. So the probability is higher because we're already in the money and we got a shorter term to expiration. So as we go deeper in the money, the deltas get higher. And look at the 155 strike. We got to pay for that. That's a real option contract. It's 2010 versus 1010, right? So you're paying $1,020 to buy that option contract plus commission. But I get a lot of delta. I get a lot of stock price representation. And that option contract is at 78. If I go to the that's a 15-day. If I go to the 36-day, it's only 72 in that instance. And it's because of everything that we said. Now, don't let that scare you. And if you don't necessarily grasp the concept of delta, don't worry. Go to the options playbook. We have a section in the rookie section that's called Meet the Greeks. Go into great detail on it. You can rehash it. And as I mentioned, and we'll put this in the chat box right now. There is a playlist that will have all of these sessions, session 1, 2, and 3 on demand inside the Ally YouTube channel. You can watch them at any time. Okay, 3:15. So now we got 2 more strategies, okay? So everything that I emphasized here was buying calls, and I only did that because they are easier for beginners to understand. I do want to highlight a put. A put would be the right to sell the underlying stock. If you buy puts, you want the market to go down. So we're just going to buy one at the money put. In our instance, our example for the last 3 days has been a 35 strike put. The stock at 35, that's considered at the money. If the stock goes up, remember we want the stock to go down. If the stock goes up, it becomes out of the money. And if it goes down, it becomes in the money. Now, I do want to emphasize this because puts are really hard to, if you just think about it in a vacuum, they're hard to figure out if they're in the money because you got to think, well, if I bought the stock now and then exercised, would I get something? As opposed to on the call option, you're saying, if I exercised and then sold, would I get something? It's the exact opposite here. So in this instance, if I bought the stock now and the market was down at 25, if I exercised, I would be selling at 35. That is considered an in-the-money option contract. Now, let's go to the presentation. Let's scroll down. Buying a put option, we're just going to look at it. I'm just going to talk a little bit about it. We're buying an at the 80 strike. Oh, in this instance, it's an 80 strike put. Okay, the at the money thing was relative to options 101. So the stock's at 80. We're bearish. Now, if you're bearish on stock, the only real thing that you can do is actually sell a stock short. There's a lot of headaches with selling a stock short. You can't do it in an IRA account, but by the way, you can buy puts in an IRA account. It's defined risk. You sell a stock short, you have unlimited risk because the stock could, in theory, go to infinity, and they won't let you do that in an IRA account. You need to have a margin, the margin feature on your account. You are literally borrowing the shares from the brokerage firm, from what they have in stock, to sell the stock first, and then your intention is that the stock would go down and you would buy it at a lower price, hence making money. In the options trading world, you can just buy a put. You have limited and known risk. If the stock does go down, you should be profitable as long as you're considering what option contract you are buying, right? And where your target is. You got to reach your target. But if you do that, we have a 30-day 80 strike put. It's an at-the-money put option, trading for $170, $170 plus commission. Notice it's only 30 days. That's why it's cheaper. We were talking about 90 days with the call. I just changed it up a little bit. Substantial profit, can't say unlimited because the stock could only go to zero. Only, I say, in quotes. Max risk is that 170, and your break even would be the strike minus 170. And this is what the profit and loss graph would look like at expiration. You need to get down to 80 minus 170, 78.30. If you're short stock, you have substantial all the way down to zero, unlimited on the upside as the stock goes up in price overall. Great alternative if you do want to get short on a particular stock. Buying buying a put option is a very interesting alternative to buying shorting a stock outright. Okay. Sell calls, getting your feet wet. I emphasized at the introduction that if I am a beginning option trader, one thing that I like to do, a lot of people are scared of selling something they don't own. That concept is tough for them. If I sell a contract, I am then, after that contract goes into my account, I am then short that contract. I don't think any basic option trader should ever sell a contract without owning the stock. But if I do sell a contract, and I sell a strike price that is higher than where the marketplace is at right now, I am just basically saying if my stock gets to that price, go ahead and take it away from me. And that's also true on the put side. A lot of people might sell puts to target a buy price down below the marketplace. So I'm going to point to it right now. It's a very common strategy that if I do have the capital to buy 100 shares of stock, I'm going to target a price down below and hopefully put the stock at the lower price. That would be my goal. If it goes on up, guess what? The option would expire worthless and I could collect the premium. So I get paid for saying I want to buy a stock at a lower price. Here I get paid for saying I want to sell a stock that I currently own at a higher price. So I've emphasized over and over again that I do not want to buy the out of the money option contract, right? And in our one scenario, we had a 90-day option contract. It was 5 points out of the money. And we were saying that if you buy that, you got to think that that underlying stock's going to get to that strike price, which I think was 65, by that expiration date. Why not sell it? If the probability is low that it's going to get to that price, but you are willing to sell it. Now, I want to emphasize, it's an obligation. You got to be willing to sell it. Then why not sell that option contract and generate income above and beyond any dividends that might get paid on the stock? This is by far the most popular option strategy that I have seen overall. And I know a lot of people that only do covered call writing and only sell puts to buy stock. And that's the way that they use options. They never buy an option outright. Now, I'm not saying that that is for you, but there are a lot of people that will use that strategy, and it's a more conservative way to use options. And it's basically, and I do have a seminar that I do that I call it Options for the Stock Portfolio, how to enhance your stock portfolio by using option contracts and these type of strategies. So let's look at this. We buy 100 shares of XYZ. We might have XYZ in our account. And I look at this at year end. I find a stock that I want to sell before the year end. Maybe I have a loss in it. I want to create that loss for tax purposes. We don't talk about taxes on this rookie's course though. But I own that 100 shares of stock. If it goes up a couple of dollars, I'm okay with selling it. I'm going to sell the 30-day call option here. I'm going to sell that. It's trading for $1. I lowered my cost basis now on the stock. If I owned it at 60, now I basically can say I own it at 59. That's the concept there, is that I'm reducing my cost basis, which means I'm reducing my risk. I'm giving a small pill to land on. If the stock goes up in 30 days, we see it above 62.50. It's at 63 or maybe 64. Well, if it goes to 70, I might be sad. Why? Because I had an opportunity cost there. The stock went through my strike and I got to give it up at 62.50. But bottom line is I would have made 6% over that 30 days. I would have made the premium plus from 60 to 62.50, and I would have made $3.50 or 6%. Now, if XYZ is below 62.50, I'm gonna lose on that position, but it needs to now go below 59 before I technically lose on the entire gaggle of securities, the option and the stock. And if it's below 59, well, then losses will occur. But where are the losses coming from? Are they coming from owning the stock, or are they coming from selling the option? It's from owning the stock. So this is part of the reason why, if you are a stock trader, that I would like you to look at doing a covered call to get the nuances of the options marketplace and the pricing, and learn a lot about options just in general. It's a great way to get your feet wet. You can't really hurt yourself. You're used to stock price risk. And if the stock does go down prior to the expiration date, you can still sell the stock. You just have to close out the call option first. You have to remove that obligation in the marketplace. And guess what? You should have a small profit on it at least. You sold it for $1, it goes down. Should be trading for less than $1 now. And each day that erodes, right, the option decays. And because of that time decay, you also have that benefit too. Overall. So all the nuances as to why you might not want to buy an out-of-the-money option contract as your first trade are flipped on its head when you sell a covered call on a position, on a stock position that you may own in your account, or if that's your first initial trade. So I got 5 minutes and I got the profit and loss graph. So now this is at expiration once again. We're saying that we did buy the 100 shares, so we're long the 100 shares, to use the vernacular we introduced on Monday. And that's at 60. We sell the 62.50 strike call for 1. And from 62.50 on up, I can't make any more. And there is an opportunity cost here, but I wanted to sell my shares. Thought it was at a high if it got up to this level. And a lot of people do that with limit orders all the time on the marketplace. They put in an order, and there'll be a good till canceled order. They last for like 60 days. On the Ally Invest platform, saying that if the stock goes up 2.5 points to 62.50, I don't mind selling it at that price. Very similar here with the call option, but I'm going to receive $1 for saying that I'm willing to sell it. All right, so stock unlimited, stock plus call. This is the red line, the profit and loss graph. Break even moves to 59 as opposed to 60. And if I do this, every month in and month out, I keep lowering that break even point at that point in time. So if you have a stock that's going nowhere, if you can find that particular stock, this strategy is a very interesting alternative to generate income above and beyond any dividends that you might receive on that stock. And if it doesn't have dividends, you can still do it, right? No big deal. Okay, so I got a lot of questions, but covered calls is scary for beginning option traders because, like I said, you're selling something that you don't own. You don't do that often in the stock world. And maybe you don't own stocks. Maybe you just own mutual funds. If you own exchange-traded funds, like the SPY, which is the S&P 500 Spider, which tracks the SPX index, yeah, you can sell calls against those trades too. They do have options on it. You can sell calls, you can buy calls, you can do all that stuff. So first question, I'm going to go through this real quick. Got 4 minutes for questions. Can I, on a covered call, can it be done as one trade? That's the way that we were doing it. We were billing it as you bought the stock was at 60, you sold the call right away. You can do that, and that's called a buy right. I'm entering all as one trade on the Ally Invest live trading platform. But the more common thing to do is to sell the call later. Why? Because when you're buying the stock, most people think, well, I think it's going to go up. That's why I bought the stock. I don't want to limit my upside. But now if I've owned the stock for a year or two and I wouldn't mind selling it because it has gone up or it's gone down and I just want to cut my losses and get out, then I sell the call. So that's much more common. And then you would use the normal order trade screen, but you can only sell, you have to have 100 shares of the underlying stock. You have to have 100 shares because that obligation is to call away 100 shares. And that's actually the point on the next part of the slide. Can I buy the stock first and then sell the call later? Yes, that's more common. Which position causes the risk? It's the stock. It's not the option. Opportunity is what you're giving up by selling the option contract. Am I stuck in the position till expiration? No. That is by far the most common question that I get. But if the stock does go down and you want to get out of that position, you do need to close the option contract first and then sell the stock. So I'm buying to close because I'm selling to open. I would be buying to close that option, and then I would sell the stock. You can also do it all as one trade, as opposed to a buy right. That would be considered an unwind. You're unwinding the position. Now, this is the one that I wanted to get to. When might I be assigned? One of the things, we sold a 30-day option contract, and usually I would sell, if I'm looking to sell a stock, I would sell the shorter term option, maybe a 15-day, maybe a 30-day, but it's all about the amount of premium that you're getting on it. And here's the reason why, is that if the stock goes up to that strike price, am I going to be assigned right away? Is that person going to exercise that call? Our call was the 62.50. Let's say it's trading at 65. Are they going to exercise that call right away because it just skyrocketed to 65 and I still have 15 days remaining to that expiration? The answer is no. And you got to think about it on the call buyer side. We've emphasized this. 80% of call options get closed out on the marketplace. If I exercise that call with 15 days remaining, I lose that time value. I also spend cash now by exercising it, right? If I exercise, I have to come up with 100 times 62.50 or $6,250 plus any fees to buy that stock. Why would I buy the stock now when I could buy the stock at expiration? I know the price. And what if it went down? I would say it's 65 now, but if in 15 days it went down to 60, well, then I would really look like the fool, right? Because I exercised, took on all the risk of owning the stock, and the stock actually went down over the next 15 days. So if you do sell that call, the assignment, if it gets in the money, will happen closer to the expiration date. Now, you're dealing with human beings, and it could be assigned at any point in time. You got to realize that. It might not make logical sense to you why you got assigned early on that position, but you're dealing with human beings on the other side of that trade. They can do whatever they want. They have that right. They paid for the right. They have that right. All right. There's a few more comments on here, but you say, do you really want to sell the shares? if you're doing this as a first-time trade, just make sure that you do want to sell the shares, that if it goes higher, you want to sell the shares. Some people sell call options just trying to make premium overall and don't really want to sell the shares. And there are some managing your position things inside the options playbook and on the website under the managing tab about how you can avoid assignment if an option contract gets in the money and you have not been assigned on it yet. All right, so a lot of Q&As. Oh my gosh, here we go. I'll stay a few minutes longer here. So all the way up here at the top. Okay, we have so far 4 questions that I have to answer. So David, how do you close out a position before the expiration? If we look at the option chain, and let's do that. Let's do that because I anticipate some more questions on that. So we're going to switch over to the actual option chain. And we actually have something that's called the quick ticket. And I'm just going to hit that on the right-hand side. And I'm going to look at the action if we were to buy a call option. So let's go on in and just buy a call option, okay? 1 second here. I am going to hit this, not meant to be a recommendation. And you will see on the drop down here, we have buy to open, sell to close, sell to open, buy to close. I've mentioned it many times, and I do know that with rookies, I want to say things in many different ways and highlight them in many different ways overall. And so this drop down, this would be an order ticket if I was going to buy an option contract or sell an option contract. If I'm long that option contract in my account, I am going to be selling to close as I'm highlighting. If I am short the option contract because I did a covered call, I am going to be buying to close in that position. And that's how I would go about entering an order overall from the option chains. Now, we do have a bigger ticket inside the Ally Invest platform if you want the whole screen and it just makes you feel more comfortable. But this is the quickest way, and that's why we call it the quick ticket. So if I were buying an option contract, it would be buy to open. I get the quote on the option. I always enter limit orders on options. I very rarely would enter a market order. I guess you could. But a limit order, here's a market, here's a limit. Limit order says I'm going to limit the price, and I might even do it. The ask is considered the natural. That's where the marketplace is at. I might even say at $4.95, but I don't want it to tick up and pay $5. I'm willing to pay $4.95. That would be $495, and that's how I would buy to open a position that I do not have in my account and initiate a new position on this Apple call option. I will even hit preview trade. How about that? Let's make the limit below the market. I don't want to buy it in this test account. So I'm going to go below the market at 470. And this is the way the order ticket would look. Buying to open 1, Apple, December 17th, 2021. Notice we're highlighting the expiration date and the year. 162.50 strike call at a limit price of $4.70. This is a good for the day order. Means it's good for this market right now that we have a half hour left in. And here's your estimated cost. Here's your estimated fees that you would have and your estimated order total overall on that position. All right, next. Do you plan on moving more videos or plan on doing more videos in the future on more option topics like spreads? A is the first name. I'm trying to just use first names. So A, we would, yeah. Definitely. We'll keep this going. Give us the feedback, right? Email us. Let us know. Answer any feedback that you get, any questions that you have. Let us know more about it. If the demand is there, we will do it. And so far, we're obviously having a lot of people that are tuning in, even live, not to mention after the fact. Also, we have many other things that we do on the Ally YouTube channel. Every Tuesday, we do the stock play of the day. So I'm going to go out of the chains for a second, and I'm going to go back to the presentation. 1 second, and I'm going to highlight this. So if you are interested, not only will I do longer events, let's get into the presentation, I do also have a landing page where you can sign up for our email letters. Ally.com/investeducation. A lot of that is my stuff that I do. Every week I do 3 or 4 seminars. Some of them are live. Stock play of the day. We talk a little bit about the markets, talk about a stock, and then I'll look at a more advanced option trade more often. Every once in a while we just talk about buying calls and buying puts. But I also highlight a lot of those on Twitter. You can follow me on @BrianOverby. Learn more about the trades by going to optionsplaybook.com. We sell the book on Amazon, but we're not a bookseller overall. We really prefer that you just get the information. So we made a companion website called optionsplaybook.com. Last one here for day 3. Can I consider buying a put on shares that I own as insurance in the event of a drop in the stock price? That's from Clinton. Answer is yes. That's called a protective put. Look up the strategy. We talked about the protective put when we talked about the pricing of an option contract yesterday. Very common that I would buy a protective put on a stock that I own. Now, not very common that I would do it 2 or 3 years out. Buying insurance, if you will, a put option on 100 shares of stock that I own is expensive. So a lot of times if I'm buying puts as a hedge, is a better term, against a downward movement in the marketplace, I'm doing it because of a known event, or maybe the markets are a little scary for me. We had a little bit of a blip that started on the Friday after Thanksgiving in the marketplace. And also, obviously, what's going on with Corona and a new variant overall has caused some volatility in the marketplace overall. Maybe I just want to get through this section. So I go out and I buy a put or two on a couple of the stocks that I own that I'm more nervous about. But I do it for the next month or so, get into the new year, and then I can just go long the stock again. Very common that would happen overall. But realize that it does cost real money to buy insurance on stocks. So we talked a lot about that yesterday. So I guess that's going to be it for this 3-part course on rookies option trading, the very basics of it. Please share it with everybody. Let people know about it. The more people that we get that like this event, we will makes us want to do more videos just overall. So a couple of things you can do. You can click subscribe. You can ring the bell. You can go to ally.com/investeducation, sign up for the email list. You can follow me on Twitter @BrianOverby. And maybe you check us out this coming up Friday, where we're going to be doing a stock play of the day overtime. And we're going to be talking about an advanced trade on options that I actually put together on Tuesday before the big downturn. Thanks for coming, everyone, and hopefully we will see you soon.